I was 37 when I had an aha experience. So there's an advisor out of Seattle, Washington. His name is Rich Stewart. And Rich was on a whiteboard and he goes, I'm going to show you how to take money out of an IRA and not pay taxes on it. So in short, there's three categories a person can save and accumulate wealth for retirement. So bucket one would be a person's pre-tax bucket. So if I said a 401k or an IRA, right, a deferred compensation plan, generally speaking, people are very knowledgeable about those because that's what their company has and or that's what they've been exposed to. The benefit is it lowers your taxable income. Everybody likes that, right? But then it grows, and when it never is touched until retirement, and then when you make withdrawals, it's taxed as income. It becomes, in essence, your new W-2 in retirement since you're no longer employed. Bucket two is your after-tax investments. We call it, you have some excess income and you want to invest and save. You can put it in the bank. You can put it in bonds or stocks. You can buy real estate with it. That money generally is liquid, and I can get access to it prior to 59 and a half without any penalties. But I have this tax rate that's called capital gains, right? Or if my investments pay a dividend, I have to pay a tax rate. But it's separate than income. And then bucket three, we call your tax-free bucket. And this was introduced in 1996 when Senator Roth out of Arizona introduced the Roth IRA concept. And that's when this movement started. And so that money is opposite of bucket one. You get no tax benefits up front, but then the money grows tax-free for the rest of your life. And so when I access it in retirement, I get that money and it's not reportable as income and it's not taxable as capital gains. So those are your three categories of investing. And so what we want to do is think about how much we should invest in each of these buckets so that when I reach financial independence age and I get to say I'm done working, how can we kind of dramatically decrease the amount of taxes we pay by taking advantage of the tax code, by withdrawing money from each of these buckets.
It is possible in theory to structure these three buckets, and that as you withdraw from these three buckets, it's possible to have an annual income of, let's say, $120,000 in retirement and really pay, I think it was less than 2% taxes, if I'm correct. I mean, yeah. Is that even possible? It sounds too good to be true.
Let's just say, hypothetically, a person wanted to live on $120,000. So that's what they felt, $10,000 a month. And so what you do is you take $40,000 from each of your buckets, $40,000 from bucket one, $40,000 from bucket two, and $40,000 from bucket three. So that's how I get to the 120. And what we're doing now is, as Uncle Sam considers money from bucket one, the IRA 401k bucket, as your income. That's your new W-2 in theory. Okay. So 40,000 is your taxable income. You get to lower that by what's called the standard deduction. Every taxpayer gets to benefit from this, regardless of what you make. Most people, generally speaking, when they're accumulating wealth, get to use their itemized deduction because they give away to charities more than the standard deduction, or they have a house interest payment, right? The interest deduction they get to deduct. So, but you get a standard deduction. So the 40,000 gets lowered by the standard deduction. And what happens is your income that's taxable gets to be around $19,000. And that $19,000 now allows you to qualify for the 0% tax rate in bucket two that many individuals don't know exist. There's three tax rates for bucket two: 0%, 15%, and 20%. And this year, 2023, if your income is less than $89,450, you qualify for the 0% tax rate. So if your income's 19, now I get to have a 0% tax rate for my bucket two investments that normally we're getting taxed at 15% or 20%. And the money from bucket three, so to back up, the $40,000 of dividends or capital gains times zero, right, is zero. So that's why there's no tax there. And then the money from bucket 3 is tax free. And so you're only paying income taxes on that $19,000. So at a 10% rate, that's $1,900. So that's how we kind of are taking advantage of the tax code. So I don't want individuals to qualify for the 0% tax rate while they're accumulating wealth, right? If you're married, filing joint, you don't necessarily, probably if you have children, want to make less than $89,000, right?
Right.
You probably don't have very much money to invest and accumulate with. But if we strategically save, then we can, in essence, camouflage our wealth from Uncle Sam and take advantage of it during our distribution years, right? From age 60 to 75, let's say. And so that's kind of the concept, is thinking ahead of how our money might get taxed in the future to take advantage of the 0% tax rate.
That's amazing. So now that you outlined it that way, it actually makes perfect sense, right? Because your new W-2 income, right, coming from your 401k IRA, that is like 40,000. So then with the standard deduction, you pay very little W-2 income tax. Because you pay very little W-2 income tax, now you qualify for 0% tax on your capital gains. And then the third bucket, your Roth IRA, that doesn't pay income tax anyway. And so now when you add up the $120,000 of income, you're actually paying very little tax. And now that you outlined it that way, it actually makes sense.
Rich Stewart challenged me when he said how to take money out of an IRA and not pay tax. I'm like, well, how do you do that? Well, he did it, but he goes, well, you take out what's equal to the standard deduction. So if the standard deduction is $20,000, I take $20,000 out of my IRA minus $20,000 deduction. It's zero tax. And that was kind of the concept. So he first challenged me when I was 37 to think strategically. And I'm so glad he did, because it changed my life personally, how I personally save, and most importantly, changed how I impact other people's lives by the advice I'm giving. So we're now thinking about, it's called asset location. So where are you saving? Where are you locating your savings so that in the future we can take advantage of the tax code? And many individuals just are not aware that the 0% tax rate exists. And it has for a long time.